The president seems to be getting frustrated. Do you think he's going to do anything about it?
I think not necessarily at these levels. I think the Fed expectations are doing just about all they can to keep the dollar from going higher. But I do think there is a serious political threat here. Of course, we all have been trained now for quite some time to believe that Trump's bark is a lot worse than his actual policy bite. But I think we could easily see an empowered Treasury to gin up the funds to do some intervention. Not something we're traditionally looking at or have seen, but it is, of course, technically possible if we get there. But I would suspect it would take, for example, new highs in the dollar, broad dollar measures above what we've seen for the cycle highs recently.
If the Fed only delivers 25 basis points this year, do you think that will be enough maybe to generate that outcome?
No, the Fed is going to have to deliver a lot more than 25 basis points. If we are seeing a material worsening of the data, I think we're going to be shocked at the clip with which the Fed cuts rates. 50 basis points to start, maybe between meetings. We could be at, you name it, doing QE before year end if the economic data is bad enough. That's my base case is at least, let's say, 100 basis points by year end.
You got 100 basis points by year end. How bad does the data have to get to generate that? Because that's certainly not consensus at the moment.
No, it's not consensus. Not that far off consensus. We're about at 100. The sort of the middle of the probability spectrum is around 100 basis points by, let's say, 11 months from now. So it's not really particularly shocking stuff. And I think what's one of the shocking things is here the U.S. yield curve. We're seeing all this all these cuts priced in, and yet over the last couple of sessions, we're actually seeing the U.S. yield curve flattening. It's pretty shocking stuff. And I think for the Fed to get ahead of the curve, they're really going to have to cut a lot and very fast. Cease QT immediately rather than remaining on the regular schedule. Just a couple of bad payrolls prints, and I think we're there. I mean, this mobilization of jobs in the U.S. has been a key contributor to growth, so it won't take much of a deterioration in the job markets to see the U.S. teetering suddenly on the brink of a recession again.
If we get a bad job print this time round tomorrow, and the ADP, not the best predictor, is pointing us maybe in the direction of a disappointing figure, do you think the market tries to price 50 back in for next time round from the Fed?
We're about 75-25 for that already. I mean, 75 for the quarter point, 25% for the 50 point. I think it doesn't matter what these jobs numbers show. I think the Fed's ready to go 50 right away.
The Fed's ready to go 50 right away. Let's assume that happens. As you say, the market's going to want more. How steep? If the Fed delivers 50, how steep do you think the change in the rate environment is going to be? Because if you get 50, the expectation will be that we could get more than maybe even what you're talking about. So you need to see a significant repricing. We've got US 10s below 2,
sure,
we've got US 30s below 2.5. How low could those numbers get?
Well, you would start off by pricing, another 50 basis points perhaps a year out from now. But if we see another month of poor data, we're going to see the market effectively pricing zero, let's say by mid-2020 or end of 2020, and starting to look at when and where the QE is going to arrive as well.
What would it take you to change your mind at this point? Let's say we see a really positive payroll number tomorrow. Does that change your thinking?
I'm sure. I mean, I'd be surprised if we saw that. That it had to be a really shocking number, I think. Then the Fed might have to hedge its bets, 25 basis points. You have to be open to all kinds of scenarios. I just suspect that where the momentum is going with the economy, what the rates markets are telling us, especially that long end of the curve, just absolutely getting crushed. I just see it shaping up in the direction I've outlined here. So that's what I'm looking for is the Fed is still, and the expectations are still far behind the curve for what the Fed will actually deliver.
We've seen the market repricing reasonably aggressively already, yet the dollar hasn't moved very much. Do we have to wait for the first rate cut for the dollar to move?
That's a great question. It's a big question. If you look back at history, we actually see when the Fed starts a rate cutting cycle, you actually tend to see a bit of dollar strength because usually that coincides with asset markets that are in significant pain. You have the shortage of dollar funding around the world that keeps the dollar sort of bid even as the Fed is cutting rates very rapidly. I suspect it might be a little bit different this time around. The dollar might sort of frustratingly stay a bit high here because of some of those reasons. But we have a different market. The Fed's more proactive. We've got a world that wants to de-dollarize. and we've got a tweeter in chief that certainly does not want a stronger dollar. This all adds up to me that we're very soon will have seen the secular high and the dollar. We're looking for some better technical confirmation and momentum to build for a weaker dollar story from here.